Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of VettaFi. Standpoint is an investment firm focused on providing all-weather investment solutions to U.S. financial advisors. An all-weather approach is an asset allocation methodology that diversifies across geographic regions, asset classes, and investment styles. The goal of this multi-layered diversification is to shield investors from the pitfalls of concentrated investing by relying on thoughtful preparation rather than unreliable predictions. And my guest today, Eric Crittenden, is the co-founder and chief investment officer of Standpoint, and he is the portfolio manager of the Standpoint Multi-Asset Fund with tickers BLNDX and REMIX. So, Eric, let's start off by having you tell me about your career path and why you started Standpoint.
I fell in love with the capital markets in, I'd say, the early 90s when I was in college, and I switched my major from public health to finance, economics, and ultimately a minor in computer science. I started off working for a pretty large family office back in Kansas in the late 90s. That was a very interesting experience for me because I got to see people make tremendous sums of money investing, a little bit of trading, some derivatives, some leverage. But I also got to see people lose tremendous sums of money. So I cut my teeth in the tech bubble, 98, 99. Ultimately, moved to Arizona, where I've lived for the past 23, 24 years now. I worked on a trade desk for a local hedge fund. I co-founded a fund of funds hedge fund company after that, that allocated to systematic equity and futures managers around the globe. I co-founded a mutual fund company after that. I left that company a few years ago, had a 2-year non-compete, and then started Standpoint, which will be my final job and where I will retire. Because now at Standpoint, this small team that I've assembled, we get to make all the decisions, and we get to build the business and run the programs the way we want to, our way. So this is I'm going to work here for the next 25 years.
Well, we want to hear about those decisions that you and your team have been making. Let's start off by having you tell me a little bit about the fund and its mandate and how it fits into the liquid alts category. Is it a liquid alt?
So that's debatable. I think most people would characterize it as a liquid alternative. However, we don't really have a home yet. You know, if you look at the Morningstar categories and the other various vendors out there, there's not a real intuitive spot for a fund like Standpoints. And I think that that's actually something to be enthusiastic about. And I say that because when we decided to build this program the way we did, we took a kind of a customer centric perspective. As I mentioned before, I had a 2-year non compete, and so did everyone else when we left our previous firm. So we had 2 years to calmly and rationally evaluate the opportunity set in the marketplace and talk to people off the record, find out what it is they're really looking for. And to make a long story short, essentially what we determined is that the unmet need in the advisor marketplace is for a product that's very similar to how I manage my own money personally. And that is a blend between global macro trends, global large cap equity, and short duration fixed income, mainly Treasury Bills, 3 to 6 month in duration. So when you blend all three of those together, you get what I feel is a very durable, all weather solution that is capable of holding its ground in really hostile market conditions like the 1970s or COVID or the year 2022, but also allows investors to capture a meaningful chunk of upside during the good times. And we determined, or at least came to the conclusion, that we feel advisors would appreciate a product like that. And we didn't see it in the marketplace already. So we thought, well, that's a good overlap between our talents and interests and an unmet need in the marketplace. So we decided to take essentially what I do for my personal portfolio and roll it out as an investable product to anyone who wants to buy it.
Interesting. Well, yeah, I know when I think of liquid alternatives, I think of usually products that have a large component of futures in them, but it sounds like yours is more equity and fixed income centered. I looked at the performance over the last 3 years. BLNDX has returned 14.07%, just a little bit more than 14%, versus 4.33% for its Morningstar peer group. Morningstar puts this in its macro trading peer group. How have you been able to achieve better results than your benchmark and than other alternative strategies?
So there's a couple things going on there. One, as we talked about a little bit, there's not really a great category for there is no all weather category or a multi asset category. So they took a look at what we do and concluded that we're mostly macro investing. Um, and I'll point out that there's a lot of equity exposure and there's some T-bill exposure in there, but I'd say that they're right. Primarily, we're macro trading, and it is futures. So it's metals, grains, energy, soft commodities, currency futures, bond futures. So it's a mixture of global equities and then all the different futures asset classes and sectors and Treasury bills. So as to your question, I will get to and answer your question. How did we do better than our peers? It's the other things. It's the equities really helped a lot. I think that global equities have had about a 7 or an 8% annualized return since we launched, and we've got a healthy slug of global equities integrated into the portfolio. T bills have paid out a lot. I think we're getting almost 5% on 6-month T bills today. And then the macro trading component has rounded out that return. So I guess what I'm saying is we're not a pure macro fund. We're a blend of macro equities and treasury bills. And those three team members roll up into a team that's very productive. And that's allowed us to have a pretty high compounded rate of return over the last 3.5 years.
Well, it does sound like an unorthodox strategy that advisors might not normally pay attention to. How does that align with your suggestions for what advisors should be looking at?
We're not very aggressive in terms of marketing. We don't tell advisors much of anything. What we do is we listen to what advisors say to us and try to get to truths. And what they tell us, in a million different ways, it all boils down to essentially one theme. And that is they would love to have an investment that's reasonably tax efficient, reasonably fee efficient, that captures a big chunk of the upside during the good times, but has the means and method to protect capital during the bad times. So, and we think that our product meets those requirements. It's not magic. It's just diversification taken to a very high level and capital efficiency inside the fund that allows us to essentially implement modern portfolio theory, but taken to its natural conclusion, including all the different asset classes that have risk premiums and volatility and whatnot. So the question about why advisors might want to use it and where they would use it, I leave that up to the advisor. We're still trying to figure out where we fit in to people's portfolios. Right. But so far, so good. And most advisors have found a spot. Some view it as a core holding, some view it as an alternative. But we don't pressure them to buy a certain amount or put us in a certain place.
So, given your ability to invest across geographies and asset classes, where are the best opportunities now? And specifically, what is your sense about valuations in the US equity market? Are those attractive?
So a little bit of a disclaimer first. We've strongly value preparation over prediction. Of course, I have opinions, but if I traded on my opinions, I probably wouldn't be in this business. So I've never done that. I've always been systematic and rules based, and try to be prepared for all the plausible outcomes and allocate risk accordingly. So from that perspective, I rarely have an opinion on where the best opportunities are right now. The rules and the portfolio suggest that higher interest rates are a good risk reward bet right now because that's what we're seeing develop in the portfolio. Um, Equities seem to be strong all around the globe. So that's something that our systematic approach is saying you need to have enough equity exposure. So we have slightly elevated equity exposure. Energy, for some reason that doesn't make a lot of sense to people, still is under pressure. Um, there were some trends in industrial and precious metals. Those have given way recently. Also, some of the trends in the agricultural markets have changed significantly in the past 6 weeks. So I would say there's not a lot of conviction right now um, in the portfolio, but those things can change inside of a month. So hopefully I didn't dodge the question too much, but it's kind of our mandate to not have an opinion and to just always be prepared to take action when the market movements warranted.
So you mentioned that you like the fact that interest rates are high. Does that translate to a larger than normal for you, let's say, allocation to short-term Treasury securities, 6 months or less, which are now offering a essentially risk-free return of more than 5%?
Indirectly, a little bit. I mean, for the most part, our idle cash goes into T-bills. So that's usually about 30% of the AUM in the fund. Sometimes it can be as high as 35, sometimes as low as 25. But when you trade futures markets, you only have to post the margin to get all of your exposure. So that means there's a lot of cash laying around in our fund, which is great because it makes it very easy to pay bills and meet redemptions and whatnot. We don't have to sell assets under pressure in order to run the fund like a lot of people do. But there's no reason to let that money sit in cash in the banking system. That's not risk free. We all have learned recently. So Treasury bills are where U.S. Treasury bills, usually 3 to 6 months in duration, is where we put that money. I would say the answer to your question is no. Just because interest rates are high doesn't increase our appetite for Treasury bills because we're just using it as a cash reserve.
So I realize you're driven by your model and not by your opinions, but what is your model telling you about any asset classes or geographies that you should be avoiding?
Well, so we do avoid some places in the world for regulatory reasons. Places like China and Russia, we don't invest there. And even if the regulations would allow, I wouldn't. Contract law and a um, communist government structure is essential. I think. At least if I'm going to put my name on something and manage other people's money, it's going to be in countries where contract law is strong. So I'll just put that out there. The model itself is avoiding Asian equities, but strongly holding European and US equities. Um, the model is kind of in flux right now when it comes to most of the commodities, which is unusual and rare. And it's usually the sign of volatility is coming up. Like when the model goes flat and is becoming risk averse, the cyclicality usually picks up going forward. It's repositioning and looking for new trends. So there's not a lot to tell you about the model right now. It's kind of in a risk off mode.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from advisor perspectives every day. So why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. You mentioned earlier that you're still trying to get a sense of how advisors are looking at the fund, but do you know whether it's typically being used as a core holding? Where, if not, where are advisors taking the allocation from when they allocate to your fund?
So now that we've been around for 3.5 years and advisors have something to look at, people are starting to warm up to the idea that this could be a core holding, and some are using it as such. But we're kind of a new company. So, historically speaking, people have just been buying it in small amounts and then watching it, mostly treating it as an alternative investment. So, making a 2, 3, 4% allocation. In the past, I would say 9 months or so, we've started to see people make 5 and even 10% allocations and treat it as a core holding. So that's good news to us. We know that the way you get ahead is to become an accepted core holding that gets a longer leash, and people like what they see. You know that I talk about the anti-cyclicality of blending uncorrelated assets together, um, where you know how modern portfolio theory works is that the returns of different asset classes stack up on top of each other, but the volatility and the risk and the drawdowns, they dilute each other if you have non-correlated assets. So we strive to go and source those non-correlated assets in order to create something that's got reasonable vol, small declines, and at an acceptable annualized rate of return. Which, if you translate that into reality, if you actually produce those results, people really kind of have no choice but to look at it as a core holding, or at least considered as such. So I'm glad to know that so far so good, and we're starting to graduate to that level.
You mentioned earlier that one of your mandates is to be tax efficient. What is the typical turnover of the fund been? What's its capital gain distribution history? And also, what's its expense ratio?
So the net expense ratio is just under 1.3% right now. The management fee is 1.24%. So the balance of that is acquired fund fees for the various ETFs that we use to source global equities. Distributions are, because we're using futures and they have a different tax regime, meaning that you can't hold the futures. You have to roll them when they expire, which means you can never hold a futures contract, or you can, but it's very difficult to hold a futures contract for more than 12 months. So there's a different tax regime for those. The way it works is that all futures contracts are mark to market, and they get something called a 60/40 tax treatment, which means 60% of your gains are considered long term and 40% of your gains are considered short term, regardless of your hold period. Doesn't matter if you hold for 10 minutes, 10 days, or 10 years, your tax treatment's the same, and you have to mark to market every year. So, and that's for most futures contracts, but not for commodity futures. Commodity futures, things like crude oil and corn and soybeans and whatnot, they're considered all short term uh, from a tax perspective. So about half of our futures are reasonably tax efficient. They're things like currencies and stock market indexes and bonds, but the other half are commodities like copper and gold and aluminum. So if you blend all that together, um, you get some taxes, but they're not. It's not like all of them are short term. It's kind of a split. So I've modeled this out many, many times in the past. Sometimes I get a 14% effective estimated tax rate. Sometimes I get a 24. It depends on where you make your money. Is it mostly in commodities, or is it mostly in financials? So now keep in mind that's part of the portfolio. The other part of the portfolio is global equities, and we use big, well-known ETFs to source those. Those are incredibly tax efficient. And we're mindful of not selling them unless there's some compelling reason, meaning like redemptions. So we're very tax efficient on that side. T-bills are not tax efficient at all. It all comes through as ordinary income, at least from a tax perspective. So when you blend all that together, historically our distributions can be as high as 6%. They can be as low as 0. I think last year they were about 2%. It really depends. If we're making a lot of money from commodities, you're going to see a tax bill. If most of it's from equities, you're not going to see much of a tax bill.
The fund has approximately 700 million in assets. Is there a point when it will be too large and you want to close it to new investors?
So this concept's very important to me. One of my mandates from day one was to build something that would not need to change as we grew. If we were fortunate enough to approach 5, 6, 7 billion dollars. So that was kind of a bummer at first. I thought, well, that's going to be hard. Turns out it's not hard at all if you liquidity weight your exposures to all your different markets. What do I mean by that? So crude oil is a very deep and liquid market. Heating oil is not so deep and not so liquid. So if you look at our positions, our crude oil position might be 20 times the size of our heating oil position. Likewise, if we have a position in gold, it's probably 7 or 8 times the size of our position in silver, and maybe 20 times the size of our position in platinum. So that's to keep the fund scalable. So we run the fund right now like it has $12 billion in it. The model believes it has $12 billion under management. And then we simply ratio the output down to our current asset base. So what that means is that for the most part, I don't have to make any changes to the model up to $12 billion if we're ever fortunate enough to approach that level. There'll be some small regulatory issues because there's position limits, that you're going to run into and things like cotton and canola and whatnot. But these are very small, minor issues. What I didn't want to do is build some alpha model program that is exploiting an inefficiency that works great at 50 million, but it can't work at 500 million. We've all done that and it's no fun. And advisors lose confidence in something that you have to change dramatically as you get bigger because now they're investing in something that's very different than what they originally bought. So we had no interest in going down that road.
Why did you choose the mutual fund investment vehicle versus, say, an actively managed ETF?
So that's a great question. I get that question a lot. So my answer is still evolving, but it's truthful. I don't like losing control over execution. And when you manage an ETF, you're really reliant on the market makers to provide liquidity to your clients. So I see that there's kind of an accountability responsibility mismatch between, let's say I launch an ETF and you decide to buy my ETF, but the bid ask spread is 40 cents on the ETF and you get terrible fills. Who do you call? You call me. But what do I say? I don't control that part. It's the market makers. So I'm constantly having to pressure the market makers, but I don't have any leverage really against them if you're new. If you're really big and you're integrated and you vertically integrate with them in some way, maybe then. But I just didn't like the idea of relying on market makers who really don't want to do this kind of work. Let me give you an example. So, in our portfolio, we have Japanese bonds, we have German bonds, we have Italian bonds, we have French bonds, we have French wheat. Um, we could have all kinds of positions overseas. So, here's a question for you. If I have a whole bunch of Japanese equities and bonds in my portfolio right now, and you go to buy my ETF, how does the market maker lay off their risk in all those Japanese markets? They're not open right now. So, and the German and French and Italian markets are about to close, or they just closed about half an hour ago. So it puts them in a bind. When you run an international portfolio that's investing in futures contracts overseas, these market makers are really set up primarily to do cash equities and they prefer to stay in the same time zone. They'll go overseas if it's, really common, well-known large cap equities. And they'll even try to do futures overseas, but it's not what they were set up to do. So when I see something like that, I become skeptical. And I've run products like this in a mutual fund structure, and it's ideally suited. I control all of the trading. I run trading operations at night, very early in the morning. I get the fills. I can monitor everything. My clients, when they want to come in, I see the flows at 5 p.m. my time. I know exactly what to do. You set up all the trade blotters. It's all an automated process, but my team and I can observe each step of the way. So we control the relationship with the broker and the exchange and the clearing and all that stuff. And I don't have to worry about, are the market makers doing a good job for my clients?
That's very interesting. Thank you for that insight. Uh, if there's one key takeaway that you'd like to leave with our audience of advisors about the concerns that they should be focusing on in their portfolio construction and investment allocations now, what would that be?
It's always the same answer for me. And that is that, every decision you make in life is a trade off. There's a benefit and a cost, but there's also unintended consequences and hidden costs and potentially hidden benefits. And the one uncompensated risk that I have seen smart people, dumb people, rich people, poor, everybody make over and over when it comes to investing is to ignore the potential for stagflation, to just pretend the 70s never happened. And I see that as an uncompensated risk to take with potentially catastrophic consequences, especially now when you have so many baby boomers entering retirement or recently entered retirement that simply can't tolerate 30 and 40% declines and a dead money portfolio for 10 years. It's just not, that can't work for them. And you're taking that risk. And most people feel like, well, I have to. I can buy stocks, I can buy bonds. I don't know what else to do. Well, stocks and bonds together did not work very well for 14 years, from 1968 to 1982. A couple of 40 and 50% drawdowns, lots and lots of risk, and no real rate of return. Who's to say that can't happen again? I look around at the macroeconomic landscape and say to myself, well, I'd be surprised if we don't get something similar to that, or maybe worse. So why take that risk? Well, it's because they don't know that there's a way to add something to your portfolio that has a good probability of thriving in that kind of chaotic environment, and that's the macro investing. So people just don't know. They look at what's conveniently available and what's being pitched to them. The industry was set up to promote stocks and bonds and real estate, and it's just inconvenient to do this other stuff. But it's not inconvenient for us, so we do it. And part of the reason that we launched Standpoint as an all-weather fund is well, we felt like it met an unmet need in the marketplace. But the other is to show people this is what you can do. If you have enough commodities, you have grains, you have agricultural products in there, you mix them with equities, you mix them with US fixed income, it's a pretty resilient, durable portfolio that doesn't cause a lot of grief from the fee and tax side. Isn't this what you actually need? So I'm trying to help people want what they need.
Wonderful. Well, we will include some links to additional information about Standpoint in the notes that accompany this podcast. There'll be a link to performance highlights on Eric's fund. There'll be a comparison among the top 20 liquid alt funds, and we'll also include Standpoint's most recent June 2023 market commentary. Eric, is there anything else you'd like to add?
No, I'm good. Thanks, Bob. I really appreciate it. You asked some great questions and good follow-up questions too. So appreciate the time. And if anybody wants to find out about us, just go to standpointfunds.com, scroll down to the bottom, enter your email. And we don't spam you. We're just going to send you the good stuff. And we really appreciate the time today.
Wonderful. Well, that link to Standpoint will be in the notes that accompany the podcast. Thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Eric Crittenden of Standpoint Funds. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.